Recording right now? Or are you on screen? Let's see.
Okay, and I am back.
Well, perfect. Well, we want to thank you all so much for joining us today. I am going to ask that everyone put themselves on mute just so that you can hear the presenter. And we will open it up for questions after each speaker. So if you have any burning questions that are coming across your mind, feel free to just type it into the chat, or you can ask when we open up in between speakers. So without further ado, I'm going to have Sandy Uziak get started with who's with RE/MAX Results. Sandy?
Great. Okay. Thank you so much, Nita. Thanks to Nita and Terry for helping put this all together. We are now entering the Rent versus Buy Zoom seminar. I appreciate you all joining. My hope is that you walk away with one or two new pieces of information that you didn't know before. And hopefully it will empower you to begin looking into buying a home. I think you'll find this informative. So let's get started. So introducing myself, I'm Sandy Uziak. I'm with RE/MAX Results, helping you make a house your home. I am a real estate agent specializing in residential home sales in the state of Maryland. And I have with me Terry Healy of Motto Mortgage and Nita Young of Stewart Title. So I'm going to go ahead and start off, provide you with some current market statistics for the month of August. So those of you that are participating, I have mailed and invited Frederick County and Washington County. So what we're going to talk about are stats first from Frederick County. Give you some ideas on what we're seeing these days in real estate and how you might be able to plan to buy a home as opposed to renting. My goal is to be a resource for you both tonight and in the future, so that and there's going to be a short question and answer like Nita said. So feel free to type in any questions that you may have or reach out to one of us later. So I'm going to start with market insight. When I speak to potential buyers, potential clients, the first thing I try to do is give an accurate picture of what the market is doing, so that they can have a realistic understanding of what's going to be happening as they go through the process of buying a home. So I'm going to go ahead and treat you all as if you were potential buyers sitting across the table from me and explain to you what's happening in the market and set some realistic expectations as to what this process will feel like. So we'll start with statistics in inventory in Frederick County. So I think, Nita, we're on slide 1. Okay.
Yeah.
Let me just there we go. So our active listings in August in Frederick, as you can see, was 475 homes. In August of 2019, there was 1,134 homes. Our active listings are down 58%. So I'll give you 3 guesses as to why we're down so significantly. And that's probably due mostly to the coronavirus that everyone has been suffering from forever. Seems like years now. So as we know, this has affected our country significantly across multiple industries, multiple businesses. And what's happening, what we think is happening in the real estate market, is that fewer people are listing their homes, maybe due to a lack of job security. Maybe one or both people have been laid off in the household. Some people are still afraid of having strangers, listing their home and having strangers come through their home. The industry has really done a great job of accommodating, our current situation. But the fact of the matter is, those are some realistic fears and scenarios. People are getting laid off, within a week or 2 of their settlement. So it is happening. So as a result, there's a lot of reasons why we see these low numbers. So if we go, to slide 3, well, what's happening too, if I can back up just for a second, as a result of the few listings, there's fewer homes for buyers to choose from. So the good news is, for slide 3, is that, for those of you who need more choices, you want to see more and make the right decision, and that you need to fall in love with that house, which you should do. The number of new listings has increased from July to August, almost 1%. So, that's good news. And the new listings is up 14% from August of 2019. So what we think might be happening, kids are starting virtual school, parents are trying to get into a new rhythm and routine, maybe feeling a little more secure about how to handle the rigors of listing their home. So you may see, going forward from here, some more homes to choose from on that market. So if we go to slide 4, the most important statistic as a potential buyer that I want you to share with you is the average days on market and the average sold to original listing price ratio. So in August, the average days on market was 25 days. So what that means is from the day the listing went active to the day it went under contract is 25 days. That's super fast. And on top of that, the average sold to original list price ratio is 100%. So sellers are getting their asking price for their home. So what that means to buyers right now in this market is that houses are going under contract quickly and they're going at full price. So right now, gone are the days of asking for 5,000 under. It's very competitive out there. So if you're putting in an offer, we are advising our clients right now to make it a realistic and appropriate competitive offer, to the market that we're currently in. There are multiple offers happening. I took a buyer out on Saturday. The house was on the market for 2 days, and I called the agent that night, and he said they had 4 offers in hand. So it's a thing. So that is really what Frederick County is doing, and that's what's important for you to know as buyers, going forward. So let's go into Washington County. And in Washington County, the active listings in August, as you can see, was 286 homes, a little bit less than Frederick County. And as compared to 2019, the active listings are down 55%, so significantly less. Let's look at the number of new listings in Washington County. Now that has also decreased. So as compared to Frederick County, there's fewer listings and newer listings in Washington County. That's gone down about over 11% and over 14% from August of 2019. So as you can see, there's a trend currently going on. And in August, the days on market average was 46 days in Washington County, a little bit longer than Frederick County. So they're not moving quite so fast. And from the time, the list ratio to the average sold list price was 97.8%. So sellers are still getting very, very close to their asking price. So now, knowing what you know as potential buyers and understanding what the market is doing, why should you buy? So right now, assuming that you're renting right now, there's some great reasons to buy right now. Terry's going to talk a little bit with you about the interest rates. They are historically low. I'm sure you've heard that. There's many different loan programs out there. And the rates, I'm seeing, and Terry, you probably can vouch for this too, but I'm seeing 2.5%. Lately there's been some FHA loans that seem to be super competitive. So we'll hear a little bit more about that. So that's one good reason. The interest rate is so low. If you're paying, here's a scenario, if you're paying $1,500 a month in rent, you're giving your landlord a generous gift of $18,000 a year. towards his mortgage. So you're helping to pay his mortgage. Now, if you go to slide 9, if you've been renting for 5 years, you've made an astronomical donation of $90,000 towards a mortgage that isn't even yours. So as you can see, it's a ton of money. So when's the last time you spent $90,000 on yourself? It's a good reason. So, and then there's also many financial reasons, benefits to own. There's potential tax benefits. Ooh, there's a fly in here. I'm not a CPA. You do need to talk to a tax advisor on your particular situation as to how it can benefit you to own a home, but it could very well keep a little bit more money in your pocket every year, and it may surprise you. So it's a super time to buy. And then lastly, pride of ownership. It's yours. You can paint the doors salmon if you want. You can do your own renovations, anything crazy you want, you can do. It belongs to you. You're in control. And all that time you're putting money back in your pocket because of all those benefits that we just discussed. Another nice thing is mortgage in regards to having a mortgage and owning a home is stability of payment. So if, for example, you've got a 30-year conventional loan, you know, you're paying the same amount every month. Your rent can increase from year to year based upon your landlord and where you're living. That can be a little off-putting. And remember, as your earning potential goes up over the years, you're still paying the same amount on your mortgage. So that is a super, you know, thing to keep in mind. So number 3, how much money do I need to buy a home? So Terry will talk a little bit more about, give you some information on that, and Nita, you can as well, but I'll tell you from a realtor standpoint, when you make a cash deposit or on an offer, it's called an EMD or earnest money deposit. It's often about 1% of the purchase price. It's not a flat number. So if you're making an offer, for example, on a $300,000 home, your deposit or your EMD, or your earnest money deposit, is going to be about $3,000. And that tells the seller that you are interested in this home. It's a competitive offer, and you know, you're in the game. So that's about a $3,000, you know, to start with. When you buy a home, you have the opportunity to have a home inspection. Those costs, depending, range anywhere from like $350 to $700. The higher end is if you're getting a home with a septic tank, well, water. You want to have those inspected as well, and those are oftentimes more costly, additional inspections required. So, you know, I usually tell people, you know, between $350 and $700. Your bank's going to require an appraisal of the property. So when you get your loan, the bank wants to make sure that, you know, they're giving you money for a house that's worth what they're lending you. And that appraisal usually costs around $500. I think that's pretty fair to say. And then closing costs, depending on the contract offer itself and the cost of the home, is approximately 3% of the purchase price. So again, that can vary, and you know, you'll hear a little bit more about that as well. So I think that kind of covers my end of it. Is there any questions thus far that I can help with? And if not, we can
Sandy,
go. Yeah.
Touch real quick on home inspection, which is and how it's different than an appraisal.
You bet. So a home inspection is, once you put an offer on a house and you're interested in buying that home, you're going to get a home inspector involved to walk through the house and check the roof, check the HVAC system, let us know if there's any concerns with the house, if things are, you know, there are any safety issues, if there are any repairs that need, if there's plumbing issues. that is covered all by your home inspection. And an appraisal on the home is separate and apart and different. It's conducted by your lender, and they want to appraise it in order to make sure that the value of the home is the amount that makes sense as to the amount that they're lending you. And Terry, you're going to put that into much better wording than I. But does that make sense?
Yep, thank you.
Okay. So I am having a brain fart and I'm trying to get my screen to expand. But anyway, I believe that that's pretty much all we're at. It's a great time to buy right now. Significantly low interest rates. And, you know, it is a process. And I always tell my clients that the very beginning of that process is working with a lender. Before I take anybody out, I make sure that they are pre-qualified, meaning the lender is going to take you through some questions and do some research on your credit and everything else to see what you can afford. And so Terry, on that point, I'm going to go ahead and send it on over to you.
Thank you, Sandy. Welcome, everyone. Appreciate your time. Basically, the first slide I have is rent versus buy, and you can see the couple here is going through bills. The gentleman looks a little frustrated, but you know, you're sitting down and you're looking at what your expenses are, what your income is, how you're making ends meet now, how you're going to make ends meet in the future. So that would be the first step that you would do as a person or as a couple, is to sit down and figure out where your expenses are, where your money goes, so on and so forth. So after you do that and you figure out what bills you have, you figure out exactly what your income is, you're going to want to sit down with the lender and talk about different things that are going to affect you with getting a mortgage and pre-qualifying or qualifying for a mortgage. Owning a home versus renting, Sandy went over some of these points, but you're building equity in something rather than giving your money to a landlord and having them build equity. It gives a great sense of pride. Been a homeowner for 37 years and proud of every minute of it. Have owned 3 homes. So it gives you a sense of pride, sense of success, sense of well-being. One thing that it has been come up with COVID is people are realizing that the space that they currently occupy may not be big enough. You're teleworking from home. If you have kids, they're teleschooling, I guess. So maybe you're finding out that the space that you have is pretty limited, especially if you're renting, you're in an apartment. You don't have the room to spread out. If you buy a home, you're going to have some more, you're going to have additional space, maybe another bedroom, maybe a basement, you know, maybe a second floor, whatever. As far as the advantages financially, I can't advise you. I'm not a tax advisor, but I do recommend that you get with a tax advisor and talk about those benefits. There are tax advantages that you can take advantage of at tax time. Certain items are you're able to write off of your income, such as mortgage interest, possibly mortgage insurance, and property taxes. So what you would want to do is sit down with a financial advisor or a tax advisor and find out where those numbers are coming from and how you'll benefit. You can certainly talk to them about possibly raising your exemptions. Maybe you're claiming married 1, maybe you should claim married 3, you clear more, and that gives you the ability to make the payment. As Sandy mentioned, you're not paying for someone else's home. The big thing is you have more privacy. If you're in an apartment now, you can maybe hear the neighbors arguing or whatever, but you know, it just gives you more privacy, and again, that helps with your well-being. Sandy mentioned stable monthly payments. Your mortgage payment is not going to go up from a principal and interest standpoint. In a mortgage payment, you have principal, interest, taxes, insurance, mortgage insurance, possibly condo or HOA fees. So the principal and interest is going to stay steady for the life of the loan. So if it's a 30-year mortgage, it's staying steady for 30 years. You're not going to have, somebody calling and saying, hey, we're going to increase your payment by $500 a month because we had a lot of repairs to make, whatever. Taxes, we have no control over. That's going to be something that's going to be in your county, your jurisdiction. And then homeowners insurance and mortgage insurance. Mortgage insurance should stay steady. Homeowners insurance can change depending on what the market is. So the first step that you want to take after you've sat down and gone over your finances and you've had some discussion and you figure out what you can do is you're going to want to sit down with a mortgage professional. This is highly recommended before you even start to look. It's probably the second phase of that dream. Again, the first phase is going to be just sitting down amongst yourselves and figuring out where your monthly expenses are, what your bills are, so on and so forth. And then sit down with the mortgage professional. And I do things a little different than a lot of lenders. Most lenders are going to sit down, they're going to look at your debts, and those debts are the debts that are reported to the credit bureau. So we're not looking at cell phone, we're not looking at childcare, we're not looking at the biggest thing in life is things that you like to do as pleasure. So what I do is I try to get into those items a little bit when I'm pre-qualifying someone so that they don't find themselves getting into a situation where, okay, great, I got this mortgage and now I can't do the things that I want to do. So I do talk a little bit about that in our meetings and discussions. And I also take into account that if you have childcare, because that could certainly throw you over the edge. You definitely want to go in deep with the lender and try to find out what you can really afford versus what somebody looking at numbers and calculating ratios says that you can afford. Okay, another thing to do early on in the process is to pull your own credit. You have the ability to pull credit through the internet. You can Google free annual credit reports. And what you want to do is you want to review that credit report. For one is you want to look at the scores and see what the scores are. Scores range from 300s to the 800s. Most lenders are going to look for a credit score in the 620 range right now. Pre-COVID, we would go down to 580. Some lenders would go down to 500. But with COVID, there's certainly been some tightening in the mortgage lending. And that is because people are losing jobs and layoffs, so on and so forth. So if you go in and pull your own credit report, review it, see where your debts are, make sure it aligns with what you've already discussed, and also make sure that there's no fraudulent activity or errors. You may have a credit card that you didn't use for 2 years and you look at it and you find out 2 years ago there was a late payment recorded. That's affecting your credit score. And you can fight those with your creditor and they can submit to the credit agencies to have that removed. So do that early in the process, probably after you sit down and go over your finances. You're going to want to pull a credit report and have that information at hand. Your lender can't use that credit report and the lender is going to pull a new credit report. Keep in mind that mortgage credit reports might be a little more stringent than a consumer report that you're able to pull, but at least it gives you some guidance and some idea of what things are, so you're not blindsided when you sit down with the lender and you find out that you have 5 judgments that you knew nothing about. So you definitely want to pull that report and take a look at it. And once you meet with your lender can recommend, we have tools that can help you recommend and improving your scores if you need to. But if you have a score in the 600s, it's definitely worth sitting down and talking to a lender. Probably something they can do for you. If you have scores sub 600, sit down with the lender anyway, because they can make recommendations to help you improve that score and help you improve it much quicker. The thing is that people will look at their credit report and they'll say, oh, okay, well, I have these 5 accounts that are open and I'm just going to close them. Well, once you close them, that history disappears from your credit report. So it makes it harder for the credit scoring models to calculate a score and your scores will actually drop. So don't do anything until you talk to a lender and find out what are the right approaches. A lot of times we walk into the furniture store or Home Depot or wherever, and we see these things, buy this sofa, interest-free, no payments for a year. Even though you're not making payments and there's no interest accruing, that's another account on your credit, and it's taken away from your high creditability. So whatever you can do, especially once you get into the loan process, do not open any new accounts. Make sure that your creditors are being paid on time. If your bill is due on the 1st and you're mailing it on the 1st and it takes 10 days to get there, you're going to get hit with a late payment. So make sure that you're making your payments in a timely fashion to all your creditors. You want to keep your revolving balances, and that's your credit cards, anything that has a revolving high credit limit. You want to keep them at 30% or below of the high credit value. So if you have let's say that you have a Visa card and the maximum high credit is $1,000, if your balance is $400, that can actually be a ding on your credit report. You want to keep them at 30%, in this case at $300 or less. Don't stop using credit cards. A lot of people make that mistake. They stop using any credit, hoping that their scores will go up. Again, that hurts your history. So as long as you follow the rules above, you can continue to use your credit. A lot of people take advantage of credit cards where they have points. So you get 1,000 points toward a gift card or airline points, whatever. And they like to use those cards, and they push everything on the card, and at the end of the month, they pay it off. That's fine. If you have medical collections are the biggest erroneous factor in credit. Your physician sends it into your insurance denies it, they submit it again, it gets denied, so on and so forth. Before you know it, it's showing up as a collection on your credit report. A lot of times lenders will overlook that. So don't rush to pay off if you've got $5,000 in medical and that's going to preclude you from buying a house. Talk to the lender first. Look for any judgments. The judgments where, for example, if I owe Sandy Uziak at Remax $1,000 and I didn't pay her, and she says, well, I'm going to file a judgment. She goes to the court and files a judgment. So look for judgments, because again, judgments can occur on a bill that you didn't even realize that you owed. Maybe it was a cell phone bill from 10 years ago and the company tried to collect and you moved and they couldn't get a hold of you, so they file a judgment. So you want to clear up any of that misinformation. So we'll go into income calculations. Basically, what lenders do is they look at everything on a monthly basis. So when you sit down with a lender, he or she is going to calculate your monthly income, not technically your annual income. If it is annual, obviously we break it down by 12 months. So in this case, you have somebody that's making $25 per hour. They work 40 hours per week. And we just calculate that out by 52 weeks and then divide by 12. Other things that we can use as income is overtime and bonus, providing that there's a history. If there is no history and you just started getting overtime and you started getting bonus this year, we are not going to be able to use that as income. The other thing that people do is they go out and they get a part-time job and they say, well, this will help me qualify. I can't use part-time income unless you've got a 2-year history consistent. No breaks, no gaps, so on and so forth. So, keep in mind that if you're looking at your W-2, you really want to look at your pay stub and find out, how much of that is actual earnings versus overtime versus bonus, so on and so forth. Now, what we do is we send out a form called a verification of employment to your employers, or we use a service called the Work Number for Everyone if your company subscribes. And that gives us a clear breakdown of your income, how much of it is regular earnings, how much of it is bonus, how much of it is income. Tells us how long you've been receiving bonus income, how long you've been receiving overtime. And it also tells us whether it's expected to continue. In some employers, unfortunately, even if you've been collecting it for 2 years, some employers check the box no because they don't want to put themselves in a position where they're basically telling that you or the lender that you're going to continue to receive overtime because maybe they can't guarantee it. They don't know what the market's going to do in the future. We've seen a lot more of that since COVID. Employers are afraid to put things like that down on paper because they feel it could come back and bite them. Okay. So now we'll talk about loan programs. As you can see, there's several loan programs over to the left here: FHA, VA, USDA, conventional, and grant programs, and we'll go over each one of those individually. So FHA is Federal Housing Administration, and FHA allows you to finance 96.5% of the sales price. FHA guidelines and ratio requirements are typically less stringent than conventional. However, FHA has two parts to the mortgage insurance. They have an upfront monthly, which is added into the loan and financed. And then they have a monthly mortgage insurance, which is part of your mortgage payment on a monthly basis. With FHA, the seller is allowed to pay up to 6% in seller help. And what that means is that when you sit down with Sandy and you write an offer, let's say the house is on the market for 300 and you write the offer for 300 and you want 10,000 toward your closing costs closing costs. Seller help cannot go toward down payment. So it would go toward closing costs and what we refer to as prepaids. So that is limited to 6%. And that has to be negotiated in the contract up front. It's not something that you're going to go back, after you're under contract and say to Sandy, hey, I don't have enough money to close. We need to go ask the seller for seller help because it's probably not going to happen. So make sure that you get with your real estate agent and you go over the cash that you have available, so on and so forth. They have to be met with the lender so that they know how to present the offer. VA or Veterans Administration is 100% financing, which is really awesome. And it also allows, the seller to pay 4% toward closing costs. Most of the time, veterans, with this being said, with 100% financing and 4% toward closing costs, most of the time you can get in for basically nothing, maybe a couple $100, maybe you're getting a couple $100 back. However, you have to be a veteran of the United States military to participate in the program. We have to verify that, and we would request from the VA a certificate of eligibility to make sure that you are eligible. USDA or Rural Development, again, another program that's awesome, especially out in like Washington County or out the further stretches of Frederick County. If the property is eligible, and how we determine that is we go into USDA's website, we type in the address, and it tells us, yes, it is in a USDA eligible area. Again, this allows for 100% financing, so no down payment. So all you need to worry about is coming up with closing costs. And again, you can get with your agent to figure out, if the seller can contribute, or if you want to write the offer where the seller contributes to pay some of your closing costs. The thing to keep in mind with USDA is we calculate two different calculations for qualifying. One is the ratio calculation, which we calculate your housing ratio and your debt ratio based on your debt, your housing payment versus your income. That's one calculation. You have to qualify that way. You have to qualify also on income limits, and income limits are based on the area, the number of people in the household. So you want to make sure that if you have, say, an 18 or 20-year-old child that's currently working, even though they're not on the mortgage, we're not using them to qualify you for the payment. We have to use that in the calculation for USDA. The advantage to that is now that you're 3 people instead of 2 people, the income limit goes up. So it can be a plus, it can be a minus. I've seen it hurt people in the past. But keep that in mind that you want to definitely, if you're going to make a USDA offer, make sure you're USDA qualified and your lender can help you with that. Conventional, Conventional financing allows you to finance up to 97%, a little bit more generous than FHA, only requires a 3% instead of 3.5% down. But there are income restrictions, and each county is different. Washington County is much lower than Frederick County. If you can put down 5%, there are no income limits. Anytime you purchase a home with conventional, it's going to require mortgage insurance if you put down less than 20%. Mortgage insurance is not a benefit to you as far as some people think it's a death benefit. Mortgage insurance is not. Mortgage insurance covers the lender in case you default. And then loan limits can apply depending on the county. Very generous loan limits in Frederick, Montgomery, so on and so forth. But again, you get into Washington County, you have to watch that as well. So the biggest hurdle, and Sandy touched on this a little bit, is how much cash do I need? Again, that's why it's real important to sit down with the lender and have them do some calculations. You'll sit down with them, and once you decide what you can afford as far as the sales price, then you got to figure out how much you're going to put down, what program you're going to go in, and then how much cash you need to close. Every good lender out there will sit down with you and draw up a fee sheet or a loan estimate, a good faith estimate. There are several different names. And this shows you what you need to close, because people say, oh, well, I only need 3.5% for FHA. Well, yeah, for the down payment, but that doesn't include closing costs. So you want to sit down with the lender and have them go over the other costs. You're going to have title fees, which Nita, I'm sure, will talk a little bit about. And then you'll also have county transfer fees as part of your closing costs. And then there's a second part to that. It's called prepaids. And what prepaids are either taxes that the seller has already paid. You have to reimburse them for the time that you're in the house. So if they pay taxes July 1st through December and you move in October 1st, you got to pay them back for October, November, and December. So that's part of it. You have homeowners insurance that's going to be included in that group as well. And you're going to want to make sure that you have your homeowners insurance in place at least 10 days before closing. I prefer it sooner than that, but most people do it at very last minute. The beauty about it is we can collect that at closing, so you can purchase it today and then not have to pay for it till you go to closing. The second part of prepaids is we have to hold an escrow account. An escrow account is basically a cookie jar that every month when you make a payment, we take part of your payment, we put it in the cookie jar, and then when the tax bill and the homeowner's insurance bill come due, we reach into the cookie jar and we look at it and we say, okay, here's Nita Young's cookie jar. We're going to pull out $2,000 because we got to pay taxes and insurance right now. So the lender pays those on your behalf. You'll still get the bill, but I always like getting those bills because I knew I didn't have to directly pay them out of my checkbook that day. So anyway, your lender's going to want to have to pad that escrow account so when those items are due, they can make that payment on your behalf. They also need to have a buffer in case, as I mentioned before, property taxes and homeowners insurance are pretty much the only part of the payment that can increase, and that's no fault of the lender. That is basically what the county decides on the tax rate and what your homeowners insurance is going to need to charge. So the next question is, okay, I sat down with my lender and he told me I need $12,000 to close. I only have $6,000. What do I do? You can ask for seller concessions. We talked about that a little bit earlier. You're going to get with your realtor Sandy, and you're going to go over the contract and you're going to ask the seller to pay $6,000. And then the other ways to get cash is to request a gift from a family member. FHA is a little bit broader. It allows friends, associates, as long as you can establish some type of relationship. Conventional has to be either a family member, a fiance, an in-law, or domestic partner. And we have to show that relationship basically with a letter of explanation. So somebody can gift you money to close. Can you borrow for closing costs? And I've had this happen once in my career, been doing this for 25 years. Somebody didn't have enough cash, so they went out and took out a personal loan to close. Obviously, before closing, one thing a lender does is does a soft pull in your credit to see if there's any new credit. We discovered that they had a new debt with Lending Tree or whoever, one of the quick lenders that'll give you a personal loan. You can't use unsecured funds to close. Any money that you use to close has to be secured against the property. So you cannot borrow closing costs. Is a state or government grant acceptable? Yes, it is. State or government grants are programs that are set up either by the state or your local government to allow for increased first-time home buyers and increased home ownership. So those grants are available through your county. Some are available through the state. You're going to have to find out whether your lender participates. Another way to get a grant is through your lender. We have a program that we participate in where the lender can give up to 5% as a grant. The grant is recorded as a second mortgage, but has no payment and has no interest. If you make your payments on time for 5 years, it's forgiven. Can the seller pay my down payment? No, the seller cannot pay your down payment. Seller help can only be used for closing costs and prepaid items. So basically, we covered a lot of things, but what you want to do when you get ready for your first meeting with your loan officer, your mortgage professional, be prepared. Come in with your most recent 2 or 4 pay stubs. And the reason I say 2 or 4, if you're paid biweekly, semi-monthly, 2. If you're paid weekly, I need 4. I need your most recent 2 months bank statements. And when we collect bank statements, we need all pages, even when page 5 is blank and it says this page intentionally blank. I don't know why they do that, but they do. So you want to make sure you have your most recent 2 months bank statement, and you want to be able to just explain any deposit that's greater than what your paycheck would be, because a large deposit could be a loan that you're going to be using for closing costs. We need to know that. You also want to check with your HR department to see how a lender can verify your employment. One of the hardest things for a lender is to track down either a phone number or a person that we can talk to verify that, yes, Sandy Uziak does work for RE/MAX Results. It's a challenge, so anything you can do to help, that's a huge help with your lender. And what that does is speeds up the process, because we can get that verification of employment out to the correct person right away. Have your last 2 years W-2 forms. If you're getting a gift, let the lender know, so that can be part of the discussion up front when we talk about money needed to close, because we show you something that says you need 12 grand, and then you're like, well, does that include my gift? Well, we didn't know about the gift. So make sure that if you have any opportunity to get a gift from a family member, to let us know that going into it. So is money coming from a 401k? You can use a 401k. You need to check with the 401k administrator, your HR department, or whoever, to find out if you can, 1, if you're eligible to withdraw from it. And 2, if you do withdraw from it, can you do a hardship where the 10% federal penalty is waived? So you would definitely want to check with your HR department concerning any 401k loans. And that's it. I appreciate your time. Thank you. Does anybody have any questions?
I have a question. Oh, can you hear me okay?
I can.
Okay. You mentioned about having a part-time job and that you would have to be in that job for 2 years.
Yes.
What about like a side job?
It's same thing, as long as we
Uh-huh.
can show that you've been there 2 years. Is the side job, are you paid W-2 or are you just paid a check?
Just paid cash. But that I deposit that into my, checking account. So
Yeah, that's hard because it's hard to verify without having supporting documentation. We would probably need copies of all the canceled checks and then a letter from that employer stating that you've been working for them for however long it's been. We're not the IRS, so we're not here to decide whether you do or don't pay taxes on it. But that one's going to be a hard one to verify.
okay, thank you.
Sure.
Going back to what you were saying with the VA, would a dependent child be able to use the parents' VA? So my dad was retired out of the Navy. Would I be able to use, or?
Unfortunately, it has to be the veteran.
Okay.
The only time someone else can use a veteran's eligibility is a spouse of a veteran where the veteran is deceased, and then they do make exceptions for that. But unfortunately, no, it doesn't work like USAA, where if you're a family member, which is a great benefit, it would be nice, wouldn't it?
All right. Thank you.
Sure.
Any other questions? Okay.
I think you're
Okay.
up, Nita.
Sounds like a plan. So I'm going to open it up with a question, and feel free to answer it, and don't be embarrassed by any answers. But does anybody have any idea as to what a title company does? It's very quiet. So
researches the title back as far as it goes of ownership to make sure there's no clouds on the title or liens or anything like that. And they provide insurance for the client.
Absolutely. That is a large part of what we do. Thank you so much for that response.
She Googled that. I'm just saying.
No, I just took my real estate exam, so I had to know all that stuff.
Awesome, awesome. So it's quite interesting because we actually represent the contract itself and facilitate the execution of the contract. So one of the things that we're looking for is evidence that the owner is actually in lawful possession of the property. They, in fact, are the owner. I will say we're also checking to make sure when it transitioned hands, the property, that it was done correctly and that the property is clear of any judgments, any liens, or anything like that against it. In the state of Maryland, we typically do a general warranty deed, and that takes us back to the past 60 years. Everyone who's had any kind of ownership interest in the property and making sure that they have actually conveyed out their interest. And looking at probate if that individual was deceased, making sure that was handled properly as well. And probate is just the process where the will is proved in a court of law and accepted as valid, and that the estate is settled according to the law of the state of the residence in the absence of a legal will. So we want to make sure that the person is in fact the owner. And sometimes, we ran into a situation one time, there was more than one person who was in probate entitled to the property. And I had somebody say, can you help us find every single person? We were like, you might need an investigator at this point, because there were a lot of people who, who were conveyed the property through probate. Some of the common title issues. Well, let me ask you something. Actually, I'm going to go back so you can't see the answers. Any idea as to the percentage of transactions that actually have some sort of title issue?
Oh boy, percentage with a title issue. I'm going to just take a guess, like 18%.
It's actually higher. 36% of real estate transactions, according to the American Land Title Institute, have some sort of title issue that's happening in it. So basically 1 out of 3 real estate transactions. Our job is to help find these issues and resolve them before the sale or purchase of the property, but sometimes it cannot be detected. It's what we call hidden defects or hidden risk. And that's what I actually want to spend a little bit of time talking about, because that is actually the purpose of title insurance. Obviously, we're going to do our best to uncover everything that we can, but things pop up that we don't find, it doesn't show at the time. And COVID's a great example of it, because when the courthouses shut down in March, no judgments, no liens, all of that was put on pause, on hold. So now, people are filing those, and it's coming out, that there were judgments and liens against individuals. That's just one recent example of, things we may not have been aware of. So some common problems, as I'm not going to hit on all of these, but unpaid or paid unreleased loans. So the person refied the property, the title company made the payment, which is part of what we do, making sure that in a refinance that the final payment is made to the previous lender, but it was paid off through the refinance, but for some reason it was never recorded or not released. That happens more often than you probably think. Housing code violations. People did work on the house and they did it without a permit. So now they're trying to sell the house. We've got to deal with that situation. LLC not in good standing. They haven't, made their payments to the state. And so therefore we have to clear that up before closing it. They can't sell that property yet. Federal tax liens, they can be enforceable for 10 years from when they were filed. So those we have to look at as well. So these are just some of the common problems that we see, and this is one reason why we see so many. But let's talk about a little bit about the hidden risks that we sometimes have. So probably most of you have car insurance, because you have to in order to drive. You maybe have some health insurance. These are all of these insurances are to help you in the event something were to happen in the future. Title insurance works the complete opposite. So it actually protects you for something that happened in the past that was unbeknownst to you. You had no idea about it. So if we knew all these hidden risks, there would be no need for title insurance. But since that's not the case, and everything is not always accounted for, this is why we have to have this. I had spoke to a gentleman who's in the business, and he had a friend who bought new construction. And he said, I don't need title insurance. And he was kind of laughing and joking with him and said, you better get it, because what if you find out it was like Indian reservation land that you guys moved on to? And I don't know how he came up with that, but it turned out to be true. His friend bought the insurance, but like, what's the likelihood you throw something, far left field like that out and it happened to be true? We see it a lot in new construction. People will say, I don't need title insurance. It's the house wasn't there. I'm the first person to own the house. But who owned the land? Who owned the land before them? Before the builder? And therein is where lies the problem. His friend was able to, to use his policy to shore up some of his, because this is the biggest investment you're ever going to make in your life. So, but the other people who in the neighborhood who did not buy, they all had to give up their homes, unfortunately. It was a bad situation, but luckily his friend was protected only because of a joke that he threw out there that happened to be true. Some of the other things that we've seen, forgery fraud. People, my aunt and I, we look a lot alike. She's just about 20 years older than I am. There was another situation that happened similar to that. The niece came in to sell the house, and you're like, wait a minute, this person doesn't quite look the age they should be according to the ID, but they look a lot like the individual. And they signed the documents. They were not, in fact, the owner. They did not have the right to sell that property. And you've probably heard stories of the mistress signing on behalf of the wife. Stuff happens, unfortunately. And that is why you have title insurance, to help protect you. So what is title insurance? And there are two different types of title insurance. So first, let me mention that the lender is going to require, if you have a loan, the lender is going to require that you provide them with title insurance to protect in the event there is a defect in title. However, the owner's policy is optional. So I put emphasis on it's optional, but I would never recommend that you not have it, because that would be the one time that something pops up and it's expensive to fight. If you had to go to court and try to remedy this on your own, you might pay an attorney. I know one who does it for $425 an hour. Title insurance is a one-time fee that you pay that protects you as long as you own the property. So even if you refinance, it's still covering you, and it is transferable to your heirs. So in the event of your death, it is still protecting your heirs as long as that property is in your name. But there are two policies to protect you as the owner. There's a standard policy, and then there's an enhanced policy. And the policy is going to protect against any lawful owner against property loss that they're experiencing from, as you can see, their liens encumbrances, defects in title. But the enhanced policy, which is a good thing to have because we're hoping that our home appreciates in value, will cover up to 150% of that value following 5 years of ownership of the property. So, and it actually will protect against some other things that are not covered in the policy. But one, like I said, the increase of the value is huge, because it's going to be based upon what the value is at the time of purchase otherwise. The other thing I wanted to mention to you is that it cannot be purchased afterwards. So you definitely want to make sure that you do consider purchasing it at the time of the initial signing. So let's talk a little bit about the title process. I know Terry and Sandy have talked a little bit about it on their end from the lending and realtor end, but from a title perspective, what happens is once Sandy has written your contract up for you and she receives the EMD or earnest money deposit, it is a good faith, good faith that I'm going to buy this property. Now, Stewart has tried to, and this was actually pre-COVID, minimize, the number of times of somebody having to come into the office or to bring anything to us. So we actually use Zocum, which is a mobile app to collect the EMD. It's pretty similar to, if you do any mobile banking, it's a lot like that. You take a picture of the check, you put in the property address that you're buying and your information, and then it gets sent over to us. And we send you something back saying it's been received. And right now we're only doing it for the earnest money deposit, but eventually we hope to be able to do so for closing costs, because as of right now, for closing, you're normally bringing wiring money or bringing in a certified check, because those are considered good funds because they're readily available and the person cannot retract those. So we'll get that EMD, we'll get a copy of the contract. That's what gets the ball rolling. And at that point, we're going to start our searches. We're going to have our abstractors going out into the courthouses. looking through everything, wills, divorce settlements, anything associated with the property. Are there any encumbrances on the property? Are there any liens against the property? And we're going to be looking at taxes, has the taxes been paid, any unpaid assessments or anything like that. And we're going to be working very closely with Terry and his team to make sure everything is correct. We're comparing numbers at the end. You'll receive what's called a CD, or closing disclosure. That'll come from your lender. You'll receive that at least 3 days prior to closing, so that you know, okay, what are these closing costs? In that, Terry mentioned that you're going to have some transfer and recordation taxes and some other things that pop up. So outside of the items that they're going to be escrowing, but I always tell people, be prepared, because you do have transfer and recordation taxes. In Frederick's, specifically speaking, you only have the transfer and recordation, the state transfer, and then the recordation tax. If you are a first-time home buyer, you do not have to pay your half of that, of the state transfer tax. Now, the recordation taxes go up in the state of Maryland effective October 1st. So they're going to go up to $14 per thousand. So they're a little bit higher than Washington County. Washington County has a state transfer, a recordation tax. They also have a county transfer tax, and their county transfer tax is at $7.60 per thousand. But there'll be 3 taxes there. They're typically split between both the buyer and the seller, unless the contract notates otherwise. And remember, we represent the contract, so we're going to follow whatever the contract is stating. I will also tell you that if you are a civil servant, Stewart Title does offer a discount to you. And what I mean by civil servant is, if you're a government employee, if you are a first responder, if you're military, if you're a nurse, you do qualify for what we call these civil servant discounts. So definitely, when you send the order over, make us aware so that we can extend the discount to you. So the next step in it is settlement day. It's the happiest day of your life. And I always say, give yourself time. I always say, give yourself at least a half a day. If you can take the whole day off, do so. Stuff happens, you never know, for whatever reason, and it's better to not be rushed. So I am a licensed notary, as well as a licensed title producer in the state of Maryland. So I do conduct closings as well. That particular day, I or someone like myself will sit down with you and go over each document, explaining, what am I paying for? What does this mean? And walk you through the process and answer any questions that you may have. We'll disperse funds that are related to the transaction. It may be, for instance, paying off the seller's loan on the property. So that lien is released from the property so that you can receive free and clear title on the new property. And then we're going to put a lien against the property. And at the end, for you, and to secure that note, the debt, until it's paid off. So we play a huge part in the process, but I love the fact that we get to participate in the best day, which is when you become officially a homeowner. So I want to open it back up for any questions that you all have for any of us at this time.
That was awesome. I don't think, and the interesting thing in all of this is, the reason why we get professionals, whether it be a doctor or a dentist or whatever, is because we need the professional in that area. So it may sound very overwhelming to somebody that's never been through the process before, but when you leave it to the hands of somebody that you trust and know that your best interest is at heart, it doesn't sound as overwhelming. So I guess my point, and we've said a lot of potential problems that could happen, but really, and as often as things can go awry, most things are fixable with a little time and some positive energy. So in buying a home, really, all of these things that we all just talked about can take maybe 30 to 45 days in a, in an average scenario. So that's why you have your title person, and that's why you have a lender that's got your back, and that's why you have a realtor that knows the contract. So, yeah.
Pat had his hand up. I don't know if he still has a question.
No, I was applauding.
Oh.
That was my applaud.
Okay.
Yay. Okay.
I thought you were asking a question. Sorry.
I was applauding. That was a great presentation.
Thank you.
But, well, I mean, now that I'm thinking about it, you're talking about discounts for people that are like on the front line. What about a home inspector? I mean, because we're out on that front line, and you ought to see some of the stuff that we've got to go through.
I love you. We'll have to see what we can do.
That's funny.
No, it was a great presentation. Thank you. I got a lot out of this.
Well,
Awesome.
thank you all for joining.
Yes. And I guess if there are no other questions, what I will do is this. We have a book, a first-time homebuyer's guide we've put together. And some of you may have heard us using terminology you're not familiar with. I mentioned a CD and an EMD and a whole bunch of acronyms that you're probably like, do I need to go learn my ABCs after this? So it is kind of an ABCs of real estate. It does have a glossary in it. So that, if you're not sure, you can just reference that. If you're interested, I can have Sandy share that with you. Just feel free to reach out to her and we can get that over to you.
Great. Great. Well, I think we're ready to wrap up. Thank you guys. Thank everyone for attending and for joining. And hopefully, everybody got a little something out of this. And, in the industry, we are so busy. Nobody wants to harass or harangue. So you feel free to call and ask a question and not worry that you're going to be on some call list. We're here to help and here to serve. So, feel free if there's ever any question. And it's, it's good to ask questions now. So, you may not be ready for another year. Ask what you need to do and plan. So, thank you. I think that was a great night, everyone.
Thank you all so much for attending. Have a wonderful evening.
Bye-bye.
Thank you. Bye.
You.
Bye-bye.
Great
Bye-bye.
information. Thank you, everybody.